What's going on, guys? Welcome back to another video. In this video, I've got another incredibly important AMC update to bring all of you this afternoon. So what we're going to be covering in this video is some research that I have done throughout the day. I've been connecting a lot of dots, and it has to do with the massive collateral crisis that is going on between these large institutions and how I believe that this is going to expedite the process in order for us to see these forced share recalls and or margin calls coming in the near future. Now, we've been talking about these a lot on this channel over the last couple of weeks, but everything that we're going to cover today essentially just confirms everything that I have been saying. So make sure you guys stick around to the end because we're going to go over a lot of very important information that you do not want to miss. So before we go any further in this video, if you enjoyed the information and analysis that I provide for you throughout this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people as possible. And the more people that we get learning about this whole AMC situation and staying up to date with accurate information, the stronger our community becomes. And if you guys would like to earn 2 free stocks with Webull, valued up to $1,850, make sure you check out that link down below in my description. So we are seeing another very volatile day for AMC. At one point, we broke up into this $63 range, but all of a sudden, we did see some selling pressure, and it was pretty obvious that the shorts were coming in full force. Now, a close above $60 a share today would be very big for us, and here is why. We're just going to cover this briefly, but we can see that there are a lot of outstanding contracts at this $60 share price and this $59 share price as well. That is about 53,000 options contracts, which could amount to a lot of buying volume coming in throughout the end of this week and the beginning of next week if the institutions who sold these options need to delta hedge. Now, let's get into this pretty substantial collateral crisis. When we come over to this article on Yahoo Finance, the EU, the European Union, blocks 10 major banks from some syndicated bond sales. The European Union is temporarily freezing out 10 banks from taking part in a series of lucrative bond sales under the bloc's pandemic debt issuance program as it carries out an assessment of their previous breaches of antitrust rules. These banks include JP Morgan, Citigroup, and Bank of America. Now, these banks right here that are listed are incredibly important, and it is not a coincidence that these are the institutions that are being listed. Now, something that we also have to keep in mind is that typically bonds are used as collateral. Treasury securities, as they're known as in the United States, are some of the best forms of collateral that different institutions will accept in order to lever up on your positions. Now, the fact that the EU is no longer allowing these specific banks to participate in these bond sales is very interesting. So essentially what this is showing us right here is that these institutions are no longer going to be able to get their hands on the collateral that they need to lever up. Now, why is JP Morgan Chase & Co. very important in this situation? Well, when we think back to what was going on in March, JP Morgan opened up 17 of what are called netting accounts. Now, this is pretty interesting that they did this because when we take a look at the definition of a netting account, netting is a method of reducing risks in financial contracts by combining or aggregating multiple financial obligations to arrive at a net obligation amount. Netting is used to reduce settlement, credit, and other financial risks between two or more parties. So what this tells me is that JP Morgan has a lot of over-leveraged positions. They are engaging in a lot of risky things, and they are creating these netting accounts to make sure that they are able to reduce their settlement obligations. Now, when we come back over here, Citigroup and Bank of America. Now, if you guys remember from my videos over the last week, we were talking about this situation with Goldman Sachs, Bank of America, and Citigroup. Now, Goldman Sachs is going to play a role a little bit later, but we can see that Bank of America and Citigroup, in addition, Jefferies, are among the firms that have adjusted their risk controls at prime brokerage operations, according to people familiar with the matter. The banks are trying to protect themselves against fallout from extreme surges and dips that have characterized trading in companies including AMC, Microvision, and GameStop. What happened here is the risk departments at all of these firms have basically come in and say, hey, you loaning out shares or actually engaging in short positions against AMC is far too risky at the current time. The margin requirements are increasing across the board. We are seeing this with the NSCC and the Options Clearing Corporation, and it's just not looking good for these different institutions, especially with the collateral crisis that is going on. So we just talked about this collateral crisis in the UK or the European Union. Now, how does the United States play a role into this? Now, this is going to be where reverse repos come up. So a reverse repurchase agreement conducted by the desk, also called a reverse repo or RRP, is a transaction in which the desk sells a security to an eligible counterparty with an agreement to repurchase that same security at a specified price at a specific time in the future. The difference between the sale price and the repurchase price together with the length of time between the sale and purchase implies a rate of interest paid by the Federal Reserve. So what is essentially going on here is that when we come to these actual reverse repos, this is essentially the Fed providing the collateral for these different institutions. Now, why would these institutions need so much collateral? We are seeing these reverse repo numbers go up above 500 billion over the last week, but actually today when we look at it, they actually decreased from yesterday. So that is another sign that tells us something is going on as well. So let's get into the reason why they need so much of this collateral. This is going to be the margin debt chart in the United States. At the current time, the margin debt is sitting at around $850 billion US dollars. Now, this number could be way higher than the actual reporting numbers that we are seeing because the Fed is continuously providing this liquidity. But if you remember the definition of a reverse repo that we just looked at, the Fed has to take those securities back eventually. And we are seeing them wind down right here. We are seeing them providing less to the market. And when we come over here, this number right here, the $720 billion, the reverse repo agreements, is supposed to be maturing over the next week or so. So what the Fed is doing here is taking that collateral away. It's sucking liquidity out of the market. And this is not very good for these institutions. So the way I see it right now, all of these institutions who are over-levered and over-leveraged on a lot of these positions, and they are basically a party to this collateral crisis, they have two options in order to keep themselves safe and kick the can down the road, or even just cut their losses right now. The first is going to be this recall of loaned assets and or a margin call. So these institutions are loaning out shares of basically every stock, but in particular, AMC has been and GameStop have been those two stocks that have been aggressively shorted. And we know that a lot of these institutions are wildly over leveraged at the current time. So margin calls and a forced share recall could potentially be coming in the near future. Now, another thing that supports this is this NSCC 002 that is supposedly going to come into effect on June 21st. But it's always possible that this gets delayed. So the NSCC is proposing to enhance its management of the liquidity risks that arise in and are born by it calculating and collecting, when applicable, supplementary liquidity deposits on each business day rather than only in advance of an options expiration activity period. So the way you should think about this is that at the current time, the NSCC is only calculating if their members are over leveraged essentially once a month. What this would do is have these calculations be run every single day. Now, the second option that these institutions can actually use is going to be they're going to loan out more assets or even use their clients' assets as collateral, and that is called rehypothecation. Now, we've seen this depository trust company piece come out over the last 24 hours, and we can see effective with the opening of the business on June 15th, Goldman Sachs International account number 5208 will activate the following additional account: Goldman Sachs International Rehype Separation Account. Now, we have to get a definition of exactly what rehypothecation is and how terrible this is for the overall market. Now, when we come over here, rehypothecation was a common practice until 2007, but hedge funds became more wary about it in the wake of Lehman Brothers' collapse and subsequent credit crunch in 2008 and 2009. Now, I highly doubt that they've actually stopped doing this because we really didn't see anything change since 2008. Now, rehypothecation occurs when a lender uses an asset supplied as collateral on a debt by a borrower and it applies its value to cover its own obligations. What this essentially means is, let's just take Goldman Sachs for an example because they are the ones who opened up this account. Now, a lot of high net worth individuals have investment accounts at Goldman Sachs, and they have money managers, financial advisors that manage that money for them. What Goldman Sachs is essentially doing here is they are taking that money that those individuals have with Goldman, and they are using it as their own collateral to enact in more trades. So essentially what they're doing is using money that isn't even theirs to maintain their margin requirements. So this is essentially kicking the can down the road and making making the problem of this collateral crisis and the over-leveraging much worse than it actually is. Now, you might be confused on how this ties into AMC, and I've briefly touched upon it throughout this video, but here are these couple of signs that I want to bring up to you guys. So if you guys have been watching the overall market over today, we have seen a lot of very specific names in the market start to sell off. So we've seen a lot of red throughout the board, but AMC was up a very significant amount at the current time. Now, if you guys remember the indicators that I have been talking about that are going to show me that we are getting close to actually start to squeeze, or we are in the squeeze, it's going to be the hedge fund bankruptcies and overall market sell-off. Now, in my opinion, the sell-off that we have seen today in the specific names in the market is not large enough to actually tell me that we are starting to get into the squeeze. But what it does tell me is that a lot of these institutions could be starting to actually sell off some of their other positions in their portfolios to maintain these liquidity standards and margin requirements. What this is telling us really is that we are winning. Our buy and hold strategy for AMC is beating all of these institutions, but nothing I say in these videos is financial advice. You can do whatever you would like with your money, but this is very big news, and I really want you guys to understand the gravity of the situation that is going on right now. And in addition to this, there is going to come a time, we do not know when it is, but I do think that it is going to be in the near future where these institutions can no longer get their hands on more collateral, and there is going to be these forced liquidations, these margin calls, and these forced share recalls by the institutions who have loaned out all of these shares. So that is going to conclude this update on AMC. If you guys enjoyed the information and analysis that I provided for you in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out in getting this information out to as many people as possible. And if you want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video, so you get to stay up to date on all of your favorite stocks, learn about a couple of new ones, and see exactly which options I am trading and which strategies I am using to trade them. So I hope you guys are having a great day, and I'll see you guys in the next video.